Hello and welcome to another CME Group Trader's Edge video. My name is David Gibbs with CME Group in Chicago. Today's Trader's Edge video is going to cover actually two product classes. Fixed income as represented in the U.S. Treasury Futures complex, but also the FX market as we consider a Euro-USD FX currency overlay strategy as well. So we're going to be examining two product classes in the combination of one trading transaction. For risk managers in fixed income, measuring risk generally takes place in two functions. The value of a basis point, or sometimes referred to as basis point value, or in US dollar products, sometimes called the dollar value of an O1 or DV01. The basis point value representing the financial change to a 0.01% change in yield in either the security or the portfolio. That's one measure of risk that risk managers use. The other common way to think about and evaluate risk in fixed income is something called modified duration. Duration is a concept that takes into account the income stream from a fixed income product and brings it back to present value terms. And what we look at when we're talking about modified duration is, again, it's a measurement of the impact financially to a change in yield. Modified duration being measured in years, but reflecting the change of a 1% change in yield. So, for example, if I have a portfolio that has a modified duration of 4 years, if interest rates were to go up by 1% or 100 basis points, it would be thought that this particular position would lose 4% of its value. If it had a 6-year duration, under the same market conditions, it would lose 6% of its value, and so forth and so on. So duration becomes an important measure of risk to a portfolio and also to security selections and how that impacts the overall modified duration of a portfolio. Why is this important to risk managers in particular? Well, because in various market conditions, if you're managing money over a long period of time, there could be market conditions where you want to either extend or reduce your duration depending on your outlook for forward rates. If you're anticipating yields to fall, it would be advantageous to extend the duration of your portfolio because lower rates mean higher prices, and the longer the duration, the greater the impact of those higher prices on the portfolio, affecting it in a positive way. But if your concern is to higher rates and lower prices, it would be defensive to reduce duration in a portfolio, therefore minimizing or reducing the negative effects of falling prices and higher yields. Either way, futures contracts, as used, or particularly the U.S. Treasury Futures complex at CME, are great tools to use to modify duration, either extending or reducing, because they're standardized futures contracts and they're just as easy to go short as they are to go long. And because they're futures derivative products, they don't require the full notional outlay of capital to reflect the notional value of the underlying. Initial margins in treasuries are roughly 5 to 10% of the notional equivalent of the risk. What we're looking at here is a depiction of yields of the generic rolling 10-year U.S. Treasury security. And going back, say, 6 months or so to the beginning of, or the end of the third quarter, beginning of the fourth quarter of this year, when yields were significantly lower than they are currently. And looking at the increase in yield, especially as we got into the first quarter of the new year. Rising yields reflecting concern about future inflation risk. If you're a portfolio manager and you're looking at yields, higher yields, it might be a good time to be either enhancing or buying additional securities to the portfolio or extending the duration to take advantage of these higher yield levels. What we're going to suggest in the next couple of minutes is that U.S. Treasury futures can be used to do just that. And this is because CME lists 7 U.S. Treasury futures contracts, and they lay over the top of the U.S. Treasury cash curve. If you look at this chart, you can see the light blue line underneath represents the on-the-run securities as measured by U.S. Treasury benchmark security at the 2-year, 3-year, 5-year, 7-year, 10-year, 20-year, and 30-year points along the yield curve. CME futures in U.S. Treasury futures are listed at the 2-year, 3-year. We have a 5-year contract. We have the classic 10-year contract, but because of the pricing mechanism, trades more like a 7-year. The new Ultra 10 trading like a true 10. The original long bond somewhere around 17 to 18 years in its effective maturity, and then the ultra long bond out around 25 years in its effective maturity. If you're interested in learning about more about where these price relative to what's known as their cheapest to deliver securities, there's going to be some links to references at the end of the presentation to dive a little more deeply into the pricing mechanism of Treasury futures. But for our purposes in today's video, just it's the idea that you can use Treasury futures because they lay over the cash market curve that makes them so useful to both risk managers and traders. To create a duration adjustment hedge ratio, again, this is covered in much more detail in one of the links at the end of the presentation, so I'm not going to go into it here, but this is exactly what we're trying to do, is to arrive at a number of contracts necessary to make the appropriate duration adjustment. For our purposes in this illustration, we're going to assume that we already know we want to do a $100 million 10-year adjustment to a position. And let's assume that this portfolio manager is European and is normally acting in the euro currency, but they want to either increase their dollar exposure or increase the exposure that they have already to US dollar interest rates by adding duration by using treasuries. Now, there's basically one of two ways we can do this. You can go out and buy the actual government securities themselves, pay their full notional amount, and adjust your portfolio that way. Or you can use the CME U.S. Treasury futures contracts to replicate that same exposure. We're going to look at an example of how to do that. But either way, by buying cash treasuries or buying treasury futures, you're going to be paying dollars for those assets, or in the case of the futures contract for the derivative position. That requires exchanging currency from euro to USD, and that implies two risks. There's the risk to the rate change in the new exposure to US rates, but also a new exposure, or an additional exposure if you've already got dollar exposure, to more euro US dollar currency risk. We're going to address both of these in the next few minutes. Let's go to the end of the first quarter, the end of March, and look at the current 10-year on-the-run yield of 1.734. Rising to that level rather rapidly in the first quarter of the year, this could have been or might be perceived by risk managers as an opportunity to extend duration or buy more risk in US dollar rate products because of their comparative attractiveness, particularly in the Eurozone to negative interest rates, or to an Asian investor to negative interest rates. 1.73 doesn't look like an incredibly high rate of return, but when compared to negative interest rates, it sure is. So at the time that we're looking at this, the Euro USD exchange rate, 1.1717, and we're going to use the Ultra 10-year futures contract as a working example of the CME Treasury futures used to extend this duration or to buy the equivalent Treasury securities. Its cheapest to deliver security, at the time of this illustration, was the 7/8% of November 2030. And that's important to a risk manager because the futures contract trades like its cheapest to deliver securities. And again, if you're looking for more information on this relationship, follow the links at the end of this presentation. Rather than go into a deep dive on that now, you just take my word for it. And the Euro FX currency in futures is represented here by its clearing symbol, 6E, and we're going to be using both the June 10-year note contract and the June Euro FX currency. It's trading at this price level. So our portfolio manager wants to gain exposure or increase exposure to U.S. Treasuries, particularly at the 10-year point of the yield curve, and they want to do this in the amount of roughly 100 million equivalent face values. Because they're going to be buying a U.S. dollar denominated asset, their currency risk relative to the euro is a weakening U.S. dollar. So let's go to our start date and look at the futures transaction. The first thing we want to do is pick one of the 7 Treasury futures we want to use for this duration extension exercise. And because we wanted to use as close to the current 10-year on-the-run equivalent, we're going to use the Ultra 10-year note. Now, in terms of its duration equivalence, its CTD is roughly 3 months shorter than the current on-the-run Treasury at the time of this illustration, so the durations are very similar. That's the reason for the selection. So the first step is to select the futures contract, and we've decided to use the June Ultra 10-year note contract. And then we need to, in step 2, identify that futures contract's cheapest to deliver security, which we've done here. Again, this is important because it helps us to arrive at our risk measurement factors, but it's also important for us to understand that the futures contract will trade like this security and not necessarily the current 10-year note Treasury. So if, for example, we were going to use the classic 10-year note, that CTD would be effectively 3 years shorter in maturity, which would be a significant difference in its duration measurement. So understanding the CTD's relationship to the on-the-run could be important in this exercise. We then need to calculate, in step 3, the conversion factor adjusted basis point value of the futures contract, and this is arrived at using this formula. And if we look at the inputs, we can arrive at a dollar value of a basis point for the 10-year note based on its $100,000 notional equivalent. Now we need to calculate our value at risk. We want to replicate a $100 million current 10-year note risk position. The current 10-year note's basis point value is roughly $874.60 per million. Therefore, a $100 million risk position equates to $87,460. That's our value at risk, and then we take our futures value of an 01, divide it into that number to arrive at the number of futures contracts that we want to use to create a replication of that risk position. So this portfolio manager buys 663 June Ultra 10-year notes at 44 and 1/32 price to replicate that risk, adding duration to her portfolio. And at the same time, she wants to create a currency overlay to limit the currency risk exposure to this transaction. And in order to do this, the first step to buy the futures or the cash would be to convert euros to dollars. At the time of this transaction, the exchange rate, 1.1717, means that this portfolio manager needs 85.35 million euros to get that equivalent $100 million risk position. And the CME Euro FX futures have a unit size of 125,000 euro per contract. It's a standardized contract, it's extremely liquid, it's easy to get in and out of, and at this notional amount does not require an enormous amount of contracts to create this overlay. How do we create that hedge ratio? Very similar to what we just did with the treasuries. What's our value at risk? It's 85.3 million euros divided by the value of the notional unit size of the contract. So we need 683 of the June Euro FX futures. Which way are we going to be positioned? Euro FX futures trade in the same quoted and traded convention as the spot market. It's Euro USD. They're in dollar terms. So if our risk is to a weaker dollar, we want to buy the futures contract. So the PM buys 683 of the June Euro FX futures at a futures price of 1.17 0.360. Now you'll notice that's slightly different from the spot rate, and this refers to the basis between the spot and the futures contract. Again, there's more details on the pricing mechanism of FX futures in the resource section at the end of the program. What happens a few weeks later? If we look at the current yield on the 10-year note on the run Treasury, it's dropped. In other words, prices have gone up. The yield is now lower by 15.2 basis points. You'll notice that the currency has also shifted. The euro is now stronger. And as a result, the futures are higher naturally, and so is the futures on the currencies. So what has happened to our overlay and to our overall extended duration position? Well, a 15.2 basis point move in the outright current 10-year note with a roughly $875 value of a basis point results on a $100 million position in a gain of $1.3 million, or a 1.3% improvement on that position, unhedged but still in USD terms. However, if you converted this back to the portfolio's domestic currency in euro, you get an entirely different picture. That results, because of the appreciation in the euro, of a loss of roughly 790,000 euros if it had been done unhedged. Let's take a look at the futures position. The ultra 10-year note, just like the on-the-run Treasury, also rallied, and in this case it moved higher by 72 30-seconds in price. Each 30-second is worth $31.25, and the portfolio manager was theoretically long here 663 contracts, producing a gain of $1.5 million. Adding that back into the 100 million, a very nice gain of 1.5%, slightly higher than the cash market gain, and this could be the result of the location 3 months on the curve. There could be some slight steepening to the yield curve here. Again, these are details that would be covered in a deeper dive. If we convert that back, like we did with the cash example, into euros, you can see a loss of 650,000 euros unhedged. However, we created that currency overlay using the Euro FX futures. That also rallied by 256.5 index points in the futures contract at $12.50 a point on 683 futures contracts, creating a just slightly greater than $2 million gain. You add that back into the Treasury gain and convert the whole thing back to euros, and you'll see a slightly different picture. $86.52 million net result over initial expense, producing what the portfolio manager had intended, was to take advantage of higher yields and to hedge that exposure in the currency by using the currency overlay, protecting the gain that took place in falling yields and rising prices in treasuries. Hopefully this gives you an example of how Treasury futures can be used to replicate a cash market exposure in U.S. Treasuries and can be used to extend or reduce duration. We could have just as simply looked at an environment where you wanted to reduce exposure. The nice thing about the Treasury as a replication of the cash is, let's say that on April 16th, the portfolio manager felt that the move had been enough and wanted to go back to a lower duration risk exposure. It would be as easy to offset that trade as selling that long position. And the roughly 700 futures contracts is not an enormous amount of size for the U.S. futures Treasury market to accommodate even in overnight trading hours. The standardized futures contracts, because they're derivative products rather than actual assets, do not require the same 100% notional payment at point of execution. They do require, however, initial margin, and that margin is somewhere between, let's say, 10 to 20% or 5 to 15% of the notional amount, depending on market conditions. So in addition to providing the replication They can also provide some capital efficiency because there's less capital outlay to achieve the replicated position. The next thing to consider is that CME futures in FX futures can be used as an effective and also capital efficient currency overlay product, or a tool for overlay strategies. And they're easily executed spot versus futures through CME's link execution tool. All of these things speak rather highly of investment managers, particularly in this case, non-dollar investment managers who are necessarily involved in US dollar fixed income products using the derivatives market as expressed at CME's Treasury products and FX currency products as a means to increase exposure, manage their exposure risk, and improve their net returns. If you're looking for further information or educational resources, I'm going to point you to a couple of resources here, some referring to the Treasury market and others to the FX markets at CME via these links, and also to our CME Institute, which is our educational portal that's available at cmegroup.com. There's additional resources there on all of our products, interest rates, FX, and other asset classes as well. Feel free to explore this at your leisure. And if you have any questions about what's been presented today, don't hesitate to reach out to me directly via my email address. With that, I'm going to conclude my formal remarks and thank you for your time, attention, and patience, and wish you the very best of luck. Thank you.